Welcome to the DX Today podcast, your daily deep dive into the AI ecosystem. I'm Chris, and joining me as always is Laura.
Thanks, Chris. Great to be here. And today we have a story that is genuinely seismic for anyone who works in tech or is even adjacent to the industry right now.
You're talking about Meta, which chose this Tuesday morning, May 20th, to begin the largest restructuring in the company's history, with notifications hitting inboxes starting at 4 a.m. local time across every time zone.
That's exactly right. And the numbers are staggering. 10% of Meta's total global workforce cut in a single day, which translates to roughly 9,000 people let go, while simultaneously, 7,000 existing employees are being reassigned to brand new AI-focused roles inside the company.
Let's unpack that distinction because I think it matters enormously. You have two things happening at once: layoffs on one hand and a massive internal pivot toward AI on the other. And those are very different signals about what Meta believes the future of work looks like.
The way Meta framed it internally is that they want to become what they called an AI-native organization, meaning the default assumption for every team and every product is that AI is doing a significant share of the labor, and humans are steering, evaluating, and innovating rather than executing repetitive tasks.
I've seen that phrase AI native thrown around a lot, but what does it actually mean in practice for the people who still have jobs at Meta after today?
It means your job description is probably changing whether you asked for it or not. The 7,000 reassigned workers are being moved into roles that involve training models, building AI tooling, running inference pipelines, or working on the agentic products Meta has been quietly developing since early 2025.
And the people who are being laid off, do we know what kinds of roles are being eliminated, or is this spread across the entire organization?
Based on the internal memo that Reuters obtained, the cuts are heavily concentrated in middle management and in teams that Meta leadership believes can be fully automated or dramatically reduced through AI, specifically operational roles in content moderation, certain engineering support functions, and administrative layers that had grown substantially during the 2021 to 2023 hiring surge.
That's interesting because content moderation in particular has always been this enormous human labor problem for Meta. Billions of posts, videos, and comments every day. And they've been building AI systems to handle more of that for years. So this almost feels like the moment where they're saying the AI is ready.
They are absolutely saying that, and they've been piloting automated moderation systems at scale since late 2024. And according to people familiar with the results, those systems are now handling over 85% of content decisions without human review on the initial pass, which is a massive leap from the roughly 60% they were at 2 years ago.
85% is a remarkable number, though I imagine the remaining 15% is where the genuinely difficult and high-stakes decisions live, the gray areas, the politically sensitive content, the edge cases that AI still struggles with.
That's precisely the argument Meta is making to justify keeping a smaller but more specialized human moderation team. And it's also their legal cover in jurisdictions like the European Union, where the Digital Services Act requires demonstrable human oversight for certain categories of harmful content.
So this isn't purely a cost-cutting move. There's a regulatory dimension here too, where Meta has to walk a careful line between automating as much as possible and maintaining enough human oversight to satisfy regulators in different markets.
Exactly right, and the EU angle is particularly interesting because Meta has been in active negotiations with Brussels over DSA compliance, and at least 2 senior people familiar with those talks told the Financial Times that the restructuring was partly timed to demonstrate to European regulators that Meta is doubling down on AI safety infrastructure rather than simply replacing humans with unchecked automation.
That's a fascinating piece of context, essentially using a layoff announcement as a regulatory positioning move, which says a lot about how sophisticated the game between big tech and governments has become in 2026.
It really does, and it connects to a broader pattern we've been tracking on this podcast. Every major AI employment story this year has had a geopolitical or regulatory subplot running underneath the surface numbers.
Let's talk about the human impact for a moment, because 9,000 people losing their jobs in a single day is not an abstraction. These are real people, many of whom joined Meta during the pandemic hiring boom, expecting long careers there. And I want to make sure we don't just breeze past that.
Absolutely, and the severance terms Meta has offered are actually more generous than most industry observers expected. Employees are reportedly receiving a minimum of 16 weeks of base pay plus 2 additional weeks for every year of service beyond the first, which for a 10-year Meta veteran translates to roughly 36 weeks of salary.
That's significantly better than what we saw in the 2022 and 2023 rounds of tech layoffs, where a lot of companies were offering the legal minimum or close to it. So is Meta trying to manage the reputational damage here, or is there something else going on?
Both, I think. There's definitely a PR calculus, but there's also a practical retention argument. Because if you're aggressively reassigning 7,000 people to new AI roles, you need the people who remain to believe the company treats its workers with dignity. Otherwise, your voluntary attrition skyrockets and you lose the talent you actually want to keep.
That's a sharp point. The way you treat the people you're laying off is a direct signal to the people you're asking to stay. And in a market where AI talent is still ferociously competitive, Meta can't afford to have its best engineers quietly updating their LinkedIn profiles.
Speaking of the talent market, the 7,000 reassigned roles are not all going to Meta AI researchers. A significant portion are going into what the company is calling AI product acceleration teams, which are cross-functional groups whose entire mandate is to ship AI features into Instagram, WhatsApp, Facebook, and the Ray-Ban smart glasses platform faster than the current cadence.
So the consumer product side of the house is getting a massive AI injection, which makes sense given that Meta's advertising revenue is directly tied to engagement, and AI-driven content recommendations and personalization are the primary lever for increasing time on platform.
And the numbers back that up. Meta's own earnings call data from Q1 2026 showed that AI-powered content recommendations on Facebook and Instagram had increased average daily active usage by 14 minutes per user compared to Q1 2025, which at Meta's scale translates to billions of additional ad impression opportunities per quarter.
14 minutes per user per day across 3+ billion monthly active users is an almost incomprehensible amount of aggregate attention. And it makes the business logic of this restructuring very clear. AI is not a cost center for Meta. It's the core revenue engine at this point.
Which is exactly why Wall Street greeted today's announcement with a collective shrug, rather than the panic you might expect from a 10% workforce reduction. Meta's stock was up 1.8% in pre-market trading this morning because investors read this as a productivity multiplier story rather than a distress signal.
Though I do wonder whether some investors are pricing in risks that aren't fully visible yet. You're talking about a massive organizational change executed in a very short time frame. And change management at that scale has a way of creating chaos that doesn't show up in the stock price for 6 to 12 months.
That's a legitimate concern, and several analysts I've read this morning flagged what they called integration risk. The challenge of taking 7,000 people whose institutional knowledge is in one domain and retraining them effectively enough to be productive in AI-focused roles within the timeframes Meta has communicated to investors.
I want to nail down those timeframes because they're central to evaluating whether this plan is realistic. Do we actually know what Meta told investors about how quickly they expect these reassignments to pay off?
Meta told investors in an internal briefing that they expect the reassigned employees to be fully productive in their new roles within 2 quarters, which is an aggressive target considering that many of these workers are moving from roles that required very little ML knowledge into roles that are deeply technical.
2 quarters to retrain 7,000 people into AI competency is either an optimistic timeline or a sign that many of these new roles are more about working with AI tools than doing AI engineering, which are very different skill levels.
That's the more charitable interpretation and, honestly, probably the accurate one. Meta isn't expecting all 7,000 people to become machine learning engineers. They're expecting most of them to become proficient users and orchestrators of AI systems that the company's core research teams have already built.
Which is actually a more interesting and possibly more durable model than just hiring more researchers. You're distributing AI capability throughout the organization rather than concentrating it in a single team, which could make the whole company more agile.
And that organizational design philosophy is something Mark Zuckerberg has been talking about explicitly since the beginning of 2026. He used the phrase AI-augmented workforce in at least 4 public appearances in Q1, and today's restructuring is the first concrete large-scale implementation of that vision.
From a broader industry perspective, if Meta pulls this off, does it become a template other large tech companies follow? Because we've already seen hints of similar moves at Google, Microsoft, and Salesforce this year.
I think it almost certainly does, and the pace at which this happens across the industry is probably faster than most people expect. We are talking about a window of 12 to 18 months before you see announcements from at least 3 other Fortune 100 tech companies that closely mirror what Meta announced today.
That has profound implications for overall tech employment, obviously, but I'm also thinking about what it means for the communities that grew up around these jobs. Seattle, San Francisco, Austin, New York, cities that built significant economic ecosystems around the assumption of stable, high-paying tech employment.
And those communities are already feeling it. The San Francisco commercial real estate market, which had barely started recovering from the 2022 remote work shock, is seeing renewed vacancy pressure, and municipal budget analysts in at least 2 California cities have quietly revised their tech sector tax revenue projections downward for fiscal 2027.
We're seeing the ripple effects of AI not just in the companies making the announcements, but in the physical infrastructure of the cities and economies built around those companies, which is a much longer and more complicated story than any single earnings report captures.
That's the story I think we'll still be covering on this podcast for the next decade, honestly. Not just which AI model beat which benchmark, but what happens to the humans and the institutions that organize themselves around an economy that AI is now fundamentally restructuring.
Before we wrap up, I want to ask you about the workers themselves, the 7,000 being reassigned rather than laid off. Is there any reporting on how they're actually feeling about this?
There's been some fascinating, candid commentary on Blind, the anonymous professional network, where Meta employees have been posting since the memo dropped. The sentiment is genuinely mixed, with some people expressing relief that they still have a job and some genuine excitement about moving into AI work, but also a significant thread of anxiety about whether this reassignment is a grace period before a second round of cuts once their AI productivity numbers can be measured.
That anxiety seems entirely rational to me. If your new role involves AI doing 70% of the work and humans doing 30%, the company has a very clear metric for figuring out how many humans are actually needed at steady state. And that number might be smaller than the current headcount, even after the restructuring.
You've just described what I'd call the reassignment paradox. The very act of moving workers into AI roles gives the company the data it needs to eventually automate those roles further, which means today's reassignment might be protecting jobs in the short term, while accelerating the timeline to eliminating them in the medium term.
That's a sobering way to think about it. And it gets at why these restructurings are so difficult to evaluate in real time. The short-term and the long-term incentives are pointing in completely different directions for the workers involved.
And for regulators, too. The EU, as we mentioned, is pushing Meta to maintain human oversight. But the economic logic of the company is pushing relentlessly toward less human involvement. And that tension is going to define a lot of the regulatory battles we see in the second half of 2026 and into 2027.
So the Meta story today is really 4 stories at once: an employment story, a business strategy story, a regulatory story, and a long-term societal story about what AI means for the structure of work itself.
4 stories minimum, and they're all intertwined in ways that make simple takes. Good layoffs, bad layoffs, pro-AI, anti-AI, pretty much useless for actually understanding what's happening.
That's all for today's episode of the DX Today podcast. Thanks for listening, and we'll see you next time.